let's one one of the what's the word? One of the rightful criticisms when you're analyzing your charts or when listening to someone else do it would always be a touch of, well, sure, hindsight's 2020. And it's true if you're looking at charts, after the fact or listening to someone's doing it. So you gotta be very careful is when is it hindsight and when is it not? And so because you're not trading in hindsight, you're trading in real time and you need to know all the nuances of what you see and don't see in real time because that's when you're participating in opening and closing positions, obviously, right? But let's take it the other way. Let's take it backwards and actually try to use hindsight as a way to help at times. So when we take it backwards, we're like, all right, what we see now, if we were to trade in reverse, you'd want to get short here because it's going to go down in here, right? Right to left. The market goes down from here and it's just going to back up, which means you would be thinking that the market's bearish up here, right? If you're going backwards. And so the point is, if you knew the market was going to go down in here and then you were able to reset and send it back forward, you'd want to be bullish in here. So if you knew this and you could rewind it back to here, it's the only tool you would need. You would get long and it goes up. All right. So then you look and say, well, what could I honestly say could get me bullish? Because you got to get bullish first and long. My steps 1, 2, and 3. But what could get me bullish to anticipate this? Let's actually try to use hindsight as a way to help us in real time when we don't have the benefit of hindsight. Here's a chart I bring in real time, and it was a chart of NVIDIA, which we watch because it's been a very influential stock to the NASDAQ and to the ES as indexes. If you take a look at this chart, earlier in the session, I said you have to be careful of being long if it gets through these two swing lows because it's got a chance to break out, continue down. You have to be careful of being short if it gets through these two. You actually throw that in there. So essentially, there's a box that you could see on this particular chart of this particular stock. You're not trading this stock, but you are watching it. You're not even invested in this stock, but you are watching it as a way to create clues. The better clues you have, obviously, the better decisions or higher probabilities those decisions are going to have attached to them. So it doesn't break out through the bottom of the box, and we know that now. But can you say honestly, in real time, that it has a chance to do this, which means go from this circle to this circle in a short period of time? Can you say that before it happens? And I think we can because I talked about it. Be careful being short above that line. Be careful being long below these guys. So you can anticipate something and not be surprised when it comes to fruition. Also, you had a gap that was filled. This particular stock, NVIDIA, gap to open lower. And so filling the gap is often something a market likes to do if you can't do it. But then the momentum, you're thinking of momentum of in this particular analysis and prediction. What does that mean? Well, if this is going up, it's certainly going to help a long position you might have in these top two charts, whether it's the NASDAQ over here or the ES over here. And if I back it up, when NVIDIA broke out to the upside, these two stocks are stocks, indexes, boom, did that, went with it. So you're like, okay, if I had a crystal ball, I want to get long in here. What could help me? The NVIDIA example I just gave you, potential to break out because it's identified a box. And then our OPP, other people's positions. Now, people in this room would answer this question really quickly. If you're looking to get long, do you want to see more shorts come in or more longs come in? The answer would be you want to see more shorts come in. More shorts equal more buyers help the price of anything go up. And that's what you think price is going to do if you open a long position. You like it to do it pretty quick, but nonetheless, you obviously think the price is going to go up if you're buying it to get long. And so here on the 2-minute, you see it's pretty dry. It's pretty low, boring, 10 short contracts, 11 long contracts over the last 2 minutes. That's what this vertical is telling us. And if you just move it through, it's still pretty, 20 to 13, low numbers, not a lot going on. Now we get a really low number on the long side, 6 people. There's not a lot of competition on the long side. And as we fast forward it, you get 50 to at one point 50 right before here, 50 and 75 to 5. If you're bullish and in an area you want to participate to open up and execute a bullish idea, which means get long, right? And you see this and you don't get long, it's almost like we got to order a CAT scan. Obviously, I'm not saying anybody and everybody should be long when you see that these numbers right here. Let me back it up, right? But you have to be bullish and want to get long in this area to start. If those two things are true, you're bullish and this is an area you wish to play to the long side, and then you see this and you don't react, that's when the CAT scan has to be ordered. Is this hindsight? The only thing hindsight is, yes, the upside's the right side. But if the idea is the upside's the right side, if the idea is you think it's going to break out to the upside, and you add that NVIDIA could give you a little bit more juice because it could break out of a box that you've identified in that important stock, and the NASDAQ also could break out of a box of these two highs, and the ES is showing you it's right above support, these two lines right here, the red and green dotted line, and it has this nice ratio of more shorts coming in versus longs. Every market has longs and shorts in it. Every market has smaller time frame day trader longs and shorts in it. When they get loaded up on one side, there's a very good chance the other side's the right side. Too many shorts, they all think it's going to go down. That's when it goes up. Too many longs, they all think it's going to go up. That's when it goes down. A market's job is to shake out when there's too many of one side. It can't go up if too many people are long. Why? Because too many people are trying to sell it to get out of a long, and too many sellers in the market in the in any product, in any service, too many are going to make that price of that product or service go down. And so you get 95. Remember how small these numbers was at the beginning? Look at this. 10 by 10, 19 by 4. Nothing going on. Nothing going on. And then all of a sudden, boom, they build up. Let's watch it. They build up right here. Jump to 42 by 10, 43, 34, 38, 34 by 13. This is a rolling 2 minutes of how many shorts and longs we've identified with this OPP tool. 37 by 5. There'd be nothing wrong right there. There'd be nothing wrong right prior to 75 by 5 to take a shot. So this is how you could use hindsight to go back if you record it and say, if I was bullish, if I was in an area. So let's say if I was bullish, step 1, and I was in an area that I think is support, step 2, what can I use to pull the trigger? The fire and the ready aim fire progression. We went over an ancillary market, NVIDIA. That's an edge because most people aren't watching, important stocks or ancillaries like that. As many YouTube videos as I do, as much as I talk about it, won't matter. The masses, a video of me talking about how important NVIDIA is to the NASDAQ and the ES could go viral, and most people still wouldn't use it. I'm telling you, because people do not do the obvious. It's pretty obvious how to lose weight, and most people don't because it's hard. And so they would look at this and say, oh, that's helpful, but it's probably hard and won't do it. So it doesn't matter how many people know something that might work or help. They still won't try it. That's just people being people. All right. So this is not hindsight. This is something in real time could help you pick better locations, which means better timing of your decisions to get long or get short. And the problem that people have is the moment to click. But when? A lot of people get decent at picking a side, bullish, bearish. They get decent at their support resistance. But then their questions become, but when? Because you could be long and you could be right. But your timing sucks. You get shook out and lose, and then it goes up. And then you get frustrated, and then you sell it, and then it goes up. Now you're really frustrated. So the point is that timing, the step three, is the most important step. Most people don't have a good step three. They don't even realize a step three is necessary or what it might be. And they don't understand the logic, the logical progression of, oh, wait, if shorts are buyers now, like open short positions are buyers, it's easy to prove because when I'm short, I'm trying to buy it, lower to make money, higher to cover my loss, but I'm a buyer nonetheless. So it makes sense. Okay, shorts equal future buyers. You can't really dispute that. So then it would make sense that too many shorts could equal too many buyers, or many shorts are many buyers. And then it should make sense that what do you need for the price of anything to go up? More buyers or many buyers. So now you're getting to understand, and the difference between learning and understanding is that clickable moment of, I get that. I see that. Following other people's positions, if you can, is helpful. And one of the most influential data points or information that you could have would be knowing unequivocally everyone's position. You could trade, you could put the mouse on the floor and trade with your toes. Just don't lend me that mouse when you're done using it. But either way, ready, aim, fire. Point is, hindsight is, if that's all you're using, it's not helpful because you're not able to use that in real time. But if you could kind of back yourself up and say, you know what, I wasn't bullish down in here, but if I was, what could be some triggers? And keep it simple. If it sounds simple to identify congestion boxes, which if you guys watch my videos, how many times have you heard that phrase, those words, congestion boxes? One of the first and earliest skill sets in reading a chart. If there's a congestion box, identify it. What does it mean? And why would it break out or have momentum above it? And it's because the imbalance of too many shorts versus too many longs is created, and the buyers are now chasing. They were comfortable all in here, and now they're like, holy shit, I got to get out. I got to get out. I got to get out. Buyers who buy it aren't as helpful, and buyers who are trying to buy it can't get filled. Those are the ones that create higher prices.